Die Sprachübertragung beginnt jetzt. Alle Teilnehmer befinden sich im Zuhörermodus.
Good morning, ladies and gentlemen, and welcome to today's BAI webinar. We will take a look at the digital infrastructure behind data production, storage, and consumption. And I'm glad to welcome one of our association members, Swiss Life Asset Managers. And I'm glad that we have great speakers today. Greetings to Zurich. Welcome, Gabriele Damiani and Elisabetta Magrini. I'd like to introduce both shortly. Gabriele brings over 20 years of experience in finance and infrastructure investments to his role at Swiss Life Asset Managers, where he is responsible for the overall core and core plus strategy across Europe and North America. And also welcome Elisabetta. Elisabetta is Senior Investment Manager in the Core and Core Plus infrastructure team at Swiss Life Asset Managers. And she's, for example, responsible for the DataBank asset management and a leading US data center platform. So welcome, Elisabetta. Welcome, Gabriele. Welcome, everyone who's dialing in today to the webinar. As always, you're, of course, feel free to send your questions to us. We will have a short Q&A session after the presentation of Gabriele and Elisabetta. And that's enough from me for now. So I will hand over to Gabriele and Elisabetta and have a great webinar.
Thank you, Philipp, and welcome everybody to today's webinar. I'll be relatively brief on our platform presentation, considering the amount of material that we need to cover in the next 45 minutes or so. But as Philipp mentioned, Elisabetta and I sit in Swiss Life Asset Managers infrastructure team here in Zurich. The asset class was created roughly 15 years ago, and since then we've deployed over 13 billion of capital across multiple geographies and sectors, including obviously digital infrastructure, where we've made significant controlling investments in the fiber tower and also data center space. Therefore, that's why we're here today, to tell you a little bit about what we're seeing in the market, more particularly with the data center universe, and who best than Elisabetta, who leads our efforts on that front to kick us off and to walk us through not only what we're seeing in terms of opportunity, but also some of the challenges that we're seeing ahead and how to navigate them. So Ellie, on to you.
Thank you, Gabe, and thank you, Philipp, for the introduction. And good morning, everyone, and welcome to our webinar. So today we'll explore one of the most transformative trends shaping our economy, which is the rise of the data and the infrastructure that powers it. So to put that into perspective, just as railways and power grids fuel the past economic revolutions and remains essential today, digital infrastructure is really the beating heart of the modern progress, because it powers every digital experience we rely on and really forms the backbone of today's economy. So, but let's start with the scale of the phenomenon. So think that every minute, 44,000 photos are uploaded on Instagram and 69 million messages are sent on WhatsApp. It is estimated by the end of 2025, the daily data creation will reach 180 zettabytes, which is probably something a bit difficult to quantify and probably even to understand. But if printed, all this information and reflected in book, we will be able to stack books of a quantity able to cover basically the distance between Earth to Moon 23 times. And that's simply staggering. But what's more important is that data today isn't just information, but it's really the foundation of a new economy. It's a strategic asset that basically powers every digital experience we rely on. But the key question here is, where do all this data live? And because the digitalization of every aspect of our lives depend on a complex and probably sometimes even largely invisible infrastructure that makes global connectivity possible. And to understand this, we really need to look at the layers of the digital infrastructure and the role that each plays in ensuring what's required by global connectivity, which is speed, security, and reliability. Behind basically every click or every video or every online transaction, there is a physical network that is made of fiber optic cables, telecom towers, satellites, network nodes, and really at the center of this all, data center. Why? Because every time we send an email or we use an app, basically data travels from our devices, that could be a laptop, a car, a phone, through what are fiber or mobile networks based on clearly the device, the input, to a first processing point. This first processing point is usually a data center, small data center, sometimes close to the end user. From there, after the data is being processed, it flows back through global networks, which could include even submarine cables crossing entire oceans, to other data centers worldwide, depending on clearly on the type of action that is needed. So this is just to give you a sense that without this infrastructure, we wouldn't have the instant access to the information, and basically the cloud services wouldn't just exist, and many technology we now take for granted simply wouldn't work. And as we said, so data center are really at the center of digital infrastructure. Why? Because they are essential to support data across the full data cycle. But what are data center? And to explain you that, I would like to show you this slide, which is a very crowded slide, but to make it simple, data center are just physical facilities that basically house thousands of servers and storage systems. And here is where data is basically processed, analyzed, stored, and then redistributed globally. And we often imagine this data center as simple buildings full of servers, but in reality, data centers are really critical infrastructure because their true value really lies in ensuring what's continuity, resiliency, and global interconnection. And in order to do that, we need data center need to have 5 key characteristics. First of all, the first infrastructure pillar is really location and latency, which are strictly correlated. So positioning in a data center is everything. And when we talk about position, it's not just geographically, but also architecturally. So a data center location must align with what's the client IT architecture and what are their latency needs. Where latency is what's defined as basically the delay between asking a system to do something and getting a response back. And in a network is basically the time from when data leaves you to when the replies come back to you. And this is usually measured in milliseconds. So that's why location is key, because it's very important in insurance, like responsiveness, but also in the ability of a data center to serve as the primary markets and integrate with the global network, guaranteeing what's operational continuity. The third block here is power and redundancy, again, which are strictly correlated. Energy is just like the lifeblood of digital infrastructure and the lifeblood of data center. A single data center can consume as much power as a small city. And that's why it requires stable, redundant, and sustainable supply. And everything, literally everything in a data center is duplicated because you cannot afford any downtime. So power, network, cooling, everything is double. The fourth point is connectivity, because as we said before, it's important a direct connection, interconnection with carriers, cloud providers, and also global backbone for the performance and the resilience of the data center. And last point is security. And here, when we talk about security, we refer both to physical and cyber security, which are both at military grade levels, because an outage or an attack can disrupt entire economies or sectors. So this is just to give you a sense of why data centers are essential, first of all, in supporting data in its life cycle, but also to give you a sense of the fact that you cannot build data center anywhere, but it requires precise condition, massive investment, and also strategic planning. So that's a bit the anatomy of a data center. And clearly, the obvious next question is, how fast is demand evolving, and what does it mean for the way we operate and the sites? And we have all heard, and we have just seen like how data centers are really the backbone of the digital economy. But to understand their strategic importance, we need also to look at the scale of what's happening globally. And I think the numbers really tell us a powerful story. Demand is accelerating at a pace that is probably reshaping the entire infrastructure landscape. If we look at the last 5 years, data center supply grew at a CAGR of 13%. But what we have seen in the last 5 years almost probably feels like slow compared to what's happening now. And the past 12 months have really marked an inflection point. There was a surge like anything before, and demand for AI workload is accelerating so fast that the industry is just shifting. And we have entered a phase of an unprecedented acceleration. Giants like Google, Meta, Microsoft, Nvidia, OpenAI are announcing like multi-billion dollar investments and building campuses of sizes that we could hardly imagine just a few years ago. And I think every day, every morning, the headlines just tell the story. As you can see in the slide, like just a few examples: new hyperscale projects breaking the ground, record-setting capital commitment, strategic partnership reshaping the digital landscape. And just to give you an idea, like recently Meta announced a campus of 5 gigawatts of power capacity, which is roughly the energy consumption of a city with 8 million inhabitants, which is basically the size of London. This is simply unbelievable. And this is a market in full swing, driven by AI for sure, but also by cloud adoption and by the relentless march of digitalization. But what are the implications of all of that? And like, if we look at numbers, McKinsey estimates that over the next 5 years, more than $6.7 trillion will be invested globally in data center infrastructure. To put that into perspective, because it's a very big number, that's equivalent to more than the combined GDP of Germany, Switzerland, and Austria. So global installed capacity will more than double by 2030. And what all of this tells us is this is just a cyclical trend, but it's really a structural transformation. And if we look a bit closer to the numbers, as we saw on slide 2, data volume is just exploding. And now we can see how the volume splits across the workload. So cloud migration and digitalization were and clearly will remain one of the main growth engines. But AI adds an entirely new layer of demand that really sits on top of like traditional data center demand. And what the numbers mean for operators and for investors. So cloud and traditional cloud are still growing, but AI will absorb now a meaningful slice of this new capacity. And AI itself, as you can see from the bottom chart, AI itself will bifurcate. So we'll have heavy compute for model training on one hand, and ultra responsive compute for inference on the other hand. And the forecast point to basically AI inference becoming the dominant workload by 2028, accounting for like roughly 3/4 of the total AI compute demand. But why does it matter? And what are really the implication of that on data center infrastructure? And I think, like, to answer this question, we really need to compare the characteristics and what differentiates AI inference versus AI training. And in very simple terms, like, training is the heavy lift. So it's about teaching model using massive data sets. It's iterative, it's compute intensive, it's power hungry, and they really need very high rack densities and robust redundancy. Location logic, in this case, needs to favor a power abundant size with multi-hundred megawatt capacity, and latency is clearly less critical than scale and reliability. Inference is different because it's all about applying those trained models to new inputs in real time. So here the emphasis is really on low latency and efficiency, and infrastructure has to focus on smaller footprints, but really fast catching and high performance networking. So that's why location here really favors like metro and edge proximity to end users, and also interconnection rich ecosystems for like instant response. So this is to tell you that once you know which workload you're serving, then the engineer clearly follows. So power, cooling, floor system, resiliency strategy, all adapt to density and the latency needs. And probably what's interesting is just to open a bit the hood and look what's really changing as a consequence of all of that inside the building, inside the data center. And this is where the difference really stands out. So if you look at this chart, like starting from the left side, traditional colocation. So traditional colocation is really built for diverse enterprise workloads. So it means that we need to be flexible and we need interconnection. So rack densities here very modest, typically 5 to 10 kilowatts per rack. Cooling for that reason is predominantly air-based with raised floor to maximize the airflow and the layout flexibility. But those type of facilities prioritize connectivity and adaptability for different type of enterprise workloads. Then moving from left to the top right, we have hyperscale. So hyperscale takes a different approach. For hyperscalers, it's all about uniformity and cost efficiency at massive, massive scale. Historically, densities were around 30 to maybe 10 to 30 kilowatts per rack, but they're really rising fast. So we are now between 30 and 60 kilowatts per rack, which is a lot more common. And clearly, hyperscale favors lab floors due to the weight of their equipment, which is quite important. Cooling in this type of environment is still mainly air first, but there are also hybrid solutions that are, of course, gaining the ground depending on the situation as densities clearly are climbing. And then there is AI, so the bottom part of the chart. AI is really changing everything, as we just discussed. So, and here we also have to make a distinction again between AI training and AI inference. When we talk about AI training, these all are really designed for extreme densities. So we're talking about 30 to 80 kilowatts per rack, which is really routine, but deployments hit 250 kilowatts. And the designs of this type of data hall are actually being engineered to support up to 1 megawatt per rack. And again, just to put that into perspective, this is basically the size of what it used to be an entire data center just on a single rack. And so given this type of densities, we're basically moving from cooling the whole room to cooling the chips directly with liquid. Air is still important with everything else in the rack, but you need to have this water that circulates to the wall boxes and then through the shortages to the racks to bring the temperature down. And given in this type of environment, heat can rise very fast, and we only have like 2 minutes of runway max. It's important to have backup pumps and buffer tanks to keep water flowing even during downtime or outages. So this is AI training. AI inference is a little bit different, and probably just to make a comparison, it sits between hyperscale and AI training. So densities are still high, but not extreme, probably between 20 to 60 kilowatt per rack. Cooling is hybrid because it depends. We need to balance in this type of environment efficiency with also compact footprint. But what's clear is that, of course, across all this model, design is now workload specific. So the right mix of air, liquid cooling, the floor system, the power architecture really depends on the density and the latency needs. And of course, as complexity rises, operators need to invest to keep the pace. And these changes require more engineering expertise that really reflects the complexity of those next generation data centers. And this shapes the economics, the risk profile, and ultimately also the investment case for data center operator. And this clearly raises another big question, which is how can investors participate in this transformation? And with this, I'll hand it over to my colleague Gabriele that will walk you through a structured view on the investor perspective and the angle when approaching this sector.
Thanks, Ellie, and I hope it's clear now that the data center landscape not only offers a lot of opportunity based on the strong fundamentals, but also presents with a series of challenges, which we'll try to cover in the next, call it 15 minutes. But if we go back to the basics, one question that we can ask ourselves is why data centers, and to really understand why data centers have become such an attractive asset subclass of infrastructure globally. I think we really need to go back to basics and look at what the structural drivers that are behind this trend. There are many. Eddie has touched a few of them already. I think we've tried to summarize them in four broad categories. The first one is the capital intensity and scalability of the data centers as space. So you can imagine that a data center requires significant upfront investment, both in power, cooling, and connectivity, which is very similar to other core infrastructure assets in the energy and transportation space. Now, this capital intensity obviously creates barriers to entry and also positions the data center to be a scalable platform. Secondly, stable and long-term cash flows. We'll discuss in a few minutes the different models, but generally speaking, data centers have evolved to provide the investors with predictability and recurring revenue stream in the form of long-term contracts ranging from anywhere between 5 to 15 years, oftentimes with highly creditworthy tenants such as cloud providers or large enterprise. Moreover, these contracts tend to be very, very sticky because relocating a data center is quite disruptive and time effective. Thirdly, Elizabeth has mentioned, data centers are mission critical. They're not just building, they are critical infrastructure for everything that we now do today and perhaps take for granted. They operate in highly specialized environments with complex technical requirements, redundancy, connectivity, security. So this makes them very, very defensible and really creates a moat against competition. And then finally, the growth-driven secular trends. So these structural demand drivers, cloud adoption, AI workloads, IoT, digital transformations, they're really fueling this exponential growth. Data centers are really at the center of this evolution, and these trends are not cyclical. They are long-term and accelerating. So now that we've discussed at a high level, why we think data centers are compelling, let's look at the different types of facilities that make the ecosystem. I think the point here is to highlight that all data centers are not created equal, and data centers are not homogeneous. So each type of data centers really serves a distinct purpose depending on the tenant profile and growth outlook. There's probably 10 different ways to categorize this. We've tried to keep it relatively simple and bucket these data centers into 5 broader categories, some of which might resonate a bit more than others. I think the first one is the one that everybody sort of thinks about when we think about data centers, which is the hyperscale. So these are the massive facilities designed for cloud service providers such as AWS, Microsoft, and Google. They tend to support large-scale applications, typically located in what we refer as Tier 1 metropolitan areas and near connectivity hubs. Elizabeth mentioned it in the past, what used to be a 50 to 100 megawatt campus a few years ago was considered large. Now that has become on the smaller end of the spectrum. So, these deployments can range anywhere from 50 to a gigawatt. But more importantly, the contracts usually are long dated, call it ranging from 10 to 15 years. And then if we scale down in terms of the size, you've got what we refer to as enterprise wholesale. So these are sizable facilities leased by large firms needing dedicated resources. Again, located in generally urban areas. Contracts usually are between 250 kilowatts and 5 megawatts, but even that's scaling higher. And the tenor, again, long-term, 5 to 10 years. And finally, you have the segment that caters for the smaller deployments for SMEs. So here again, you're going one step below, so it's 250 kilowatts to probably 1 megawatt. Contracts tend to be a little bit shorter in tenure, call it 1 to 5 years. And then you have two other categories, which maybe we think of a little bit less. The first one is edge. So edge facilities really are designed for ultra low latency and real-time processing. So these are critical for IoT, autonomous vehicle, and AI type applications. They're obviously located in urban areas. Latency, as we mentioned before, is the speed at which the information is sent and is returned. So you can't afford to have a long time between the request and the return of the data point. And these contracts are generally very, very small, under 1 megawatt type of deployment. And finally, somewhat of a quirky but very, very important integral part of the data center ecosystem is what we refer to as interconnection or carrier hotels. So these are the central hubs for fast data exchange between service and network providers. So imagine large hyperscale data center feeding into a smaller room where it will meet with ISPs, so internet providers, and MNOs and mobile providers, and the data is exchanged there in real time. So these contracts are relatively small, but they are extremely sticky due to their strategic location and importance in the broad ecosystem of data compute and transfer. So I think understanding these segments sort of help us understand where the demand is coming and what type of risk profile one wants to take. Now, the opportunity is abundant. So investors can decide to invest across these topology of data centers, but also can decide to invest across different risk spectrum. And what we're trying to advocate here is not one strategy over the other, because ultimately where you deploy the capital depends on your risk appetite. What we've tried to do, though, is illustrate a little bit the spectrum, starting from obviously lower risk, low return, all the way to the higher end of the spectrum. Very briefly, the PropCo is what we refer to as the low end risk of the data center exposure, where you're really taking land and call it shell, or the outer walls of the building exposure. Returns tend to be a bit more modest, and this is really a pure play real estate type of investment. Then you have a segment that has become a bit more popular over the last few years, which is the asset co or stable co. Some people have referred to it as also as the yield co, but this is really a strategy that is income focused, where a group of data centers are oftentimes bundled into an SPV and then sold. So there you are actually getting exposure to built, operating, and long-term contracted assets, and you're taking counterparty risk usually with hyperscale type tenants. Returns are a little bit higher, but obviously you're not able to tap into the growth trajectory of the broader sector. Thirdly, you have the platform, which platform investments usually combine both operating assets and visible development pipeline. By the combination of these two elements, returns tend to now hit the mid-teens and exceed it. But obviously execution risk rises with respect to permitting, power access, tenant commitments, and obviously the construction of these facilities. And finally, at the far end of the risk spectrum, you've got what we refer as the DevCo, which is really focusing on greenfield development. Here, obviously, you take greater risk. You don't have an asset base of operating data centers. You are, you're hunting for land, you're hunting for power. You need to build your credibility and your track record in terms of being able to secure tenants and execute on the project. So a high risk, high return, but there are several, if not multiplying number of DevCos that are coming to market these days to try to answer at the demand that is exponential. And I think the last point I'll mention on this one is that across all the structures, really the success depends on the competitive positioning in the market. Obviously, the negotiating power, like I said, with hyperscale and the wholesale retail tenants, access to land and power, liquidity, which means the amount of capital that you have to be able to deploy the strategy and build the site, and obviously operational excellence. Opportunities are strong. You have no idea how many data center platforms, assets are coming to market every day, but equally, there's a lot of questions and structural shifts that are cause for pause. So we've tried to summarize here a very, very short list, and the list could have been a lot longer, of what we think through when we're thinking of data centers today, as we feel that we're somewhat at a crossroads in terms of where the sector is going. So on one side, you've got, call it the demand growth and structural shift that we need to think through, and on the other side is the risk and questions that we foresee that we'll need to address. If I pick a few, I think that the biggest shift over the last several years has been the transition from what used to be a real estate first to now a power first type of dynamic. So utilities interconnection queues have really become the pacing factor. Securing power is now more critical than securing land, and resulting in a fundamental shift in project planning. We've also seen hyperscale dominance. So hyperscalers now account for 44-45% of the global capacity, and that's about to continue to grow. This is a big growth compared to what it used to be 6 years ago, signaling a certain level of consolidation in that segment and scale economics. And then Eli has mentioned it in the past. I think there's an ongoing changing in design. So I think AI workloads have really rewritten the rule book. That rack densities, as we've mentioned, jump from 10 to 20 kilowatts and now 80 kilowatts plus. So it's pushing liquid cooling and also new hall configurations. It's not incremental in terms of what we need to do now with data center. It's really transformative. And then when we look at the risks that lie ahead, one cannot think about, I don't know if we want to call it AI bubble, but we refer to it as an oversupply risk. So meaning if AI demand really slows down and hyperscale commitments soften, could capacity really outpace demand? We need to think about capital concentration. So we're hearing every day about these giga complexes where you would get increased exposure to single markets and single tenants, amplifying concentration risk. Supply chain constraints, which we'll touch a little bit later on. It's nice to be able to say we could build a data center, but then you actually need the equipment to do it and the labor and the construction material. And that's affecting timelines of delivery, power constraints that we've discussed, and lastly, but not leastly, this is a technological industry, and we've seen rapid evolution, which could render some design obsolete or forcing costly retrofits. So we still remain quite optimistic about what the world has in store for us in terms of data center investing, but obviously we're thinking about some of these challenges. And I think success will really depend on the power strategy, the design adaptability, and the supply chain resilience. I'll hand it over now to Elisabetta, who can quickly walk you through how we've looked at it and perhaps how we're trying to manage these challenges today, but also be ready for the unknowns of tomorrow.
Thank you, Gabe. And as you can see in this slide, the question here is how can ensure resilience and creation of long-term value in this type of environment, which is very dynamic and fast changing. And we think the answer is quite simple, but also powerful. And it's basically investing in high quality infrastructure platform that can combine scale, connectivity, and flexibility. And that's exactly what we see in our case study, DataBank. DataBank is one of our investments of the Core Plus strategy, the sort of vintage of our flagship fund, GIO3. DataBank is a data center provider in the US. It's with the largest geographic reach of any other US data center operator, with location in 27 markets, including 17 of the top 20 metros in the US. The footprint today counts 450 megawatts of build capacity and over 65 data center facility. But scale is of course important, but what really matters is how the scale is structured. And to understand that, we need to look at the layers of the DataBank platform and why they matter for its customers. So the DataBank strength really lies in its multi-layer architecture, which combines three critical components or different type of data center, just to make a connection with also Gabe explained to you in terms of different data center configuration. So we have on one side, metro and hyperscale edge. So as I said before, over 65 data center in tier 1 and 2 metros, which are positioned within basically 100 miles of 60% of the US population. And those type of locations are ideal for hyperscale, large enterprise, and wholesale workloads that really need scale, but also reliability. Then we have interconnect edge. So those are the more than 15 measure interconnect location that are part of the DataBank footprint. The interconnect location are always called like carrier hotels. Those are small data center, usually located in the city center because proximity to the end user is very key here. And those are characterized by the presence of cross connection between the customer and those environments through what are basically fiber optic cables among their equipment, which allow instant exchange of information. And the DataBank facilities support over 30,000 of those cross connects and create basically an open and neutral ecosystem for networks, software as a service provider, enterprises. And this is really where connectivity becomes a competitive advantage, especially for enterprise and retail customers who rely on rich interconnection fabrics for their performance. And then we have the third box, which is mobile and low latency edge. So those are modular and micro edge data center for ultra low latency application, which are close to the end user, which are perfect for workloads that require real-time responsiveness. And we talked about AI inference before, or also edge computing. So why is that important? So we said AI inference thrives on proximity and interconnection. Hyperscale and enterprise wholesale workloads need availability, need power blocks. But at the same time, we also have enterprise retail customers that depend on flexibility and connectivity because they need to integrate their system with the cloud and with the carrier ecosystem. So DataBank can serve all of these needs on the same platform, which is a very rare capability in today's market. And what does it look like in practice? Those three layers, so the metro, hyperscale edge, interconnection, and a low latency edge, translate really into a distinctive strategy. And this is how DataBank turns its architecture really into competitive positioning. And it has been able to really position itself as a strategic player in the digital ecosystem for its clients. And we think there are three key aspects of the DataBank strategy that really set its strategic positioning apart versus any other player in the market. The first that we already mentioned before is the geographical footprint. So DataBank serves 27 markets, different markets, is the number one player in the US in terms of number of markets served, and this gives customer proximity to measure metro and low latency access to the end users. Then we have the data center design, which is very critical. DataBank developed this universal data hall design, which can pivot between traditional colocation, hyperscale deployment, AI workloads. So whether it's liquid cooling for 250 kilowatt per rack, or hybrid design for inference pod, or retail interconnection, DataBank can serve them all. And then interconnection rich ecosystem. So those 30,000 cross connect and more than 15 carrier hotels that really create this dense fabric for clouds, software service provider, enterprise traffic, which is a huge advantage for latency services, sensitive application. And as we mentioned, so these three distinctive factors allow the company to capture a very wide range of use cases, from hyperscale deployment to connectivity-centric enterprise retail solution. And this is key. This is very important because, as also Gabe mentioned before, technology cycles are really accelerating today. And platforms that can adapt quickly from cloud to AI to edge, will continue to capture demand and deliver resilience. And DataBank strategy is really built for this adaptability. And clearly we know that strategy only matters if it shows up in what customers can in the end buy. And let's map a bit the positioning into concrete services and contract type across different services. So I'm not gonna spend too much time on this slide because I think we covered already the key characteristic of the different segments and client type. But the key message here is that basically DataBank can really offer a range of services that are tailored to different customer needs. And from hyperscale and enterprise wholesale customers that have deployments of 1 megawatt and above and a specific contract type, with those are usually long-term agreements or in the specific design requirements, to enterprise retail, which are on the other side of the spectrum, so shorter contract, smaller contracts also in terms of size, but also to manage hosting a cloud. So those are solutions for enterprises that basically lack internal IT resources, and DataBank provides the infrastructure, but also the management, so customer can focus on what's their core business. And this diversity matters because in the end it creates sticky relationship across the different customer segments. So whether it's an hyperscale signing a 15-year lease or a mid-sized enterprise that needs a managed solution, DataBank can deliver, and that drives utilization and drives long-term value, because you can work through digital disruption and through cycles. And again, all of this is not just a wonderful story, but as already proven, is value in practice. We invested in the company in August of 2022, and since the acquisition, DataBank really had an extraordinary growth plan, which wasn't just a story of growth, but really a story of strategic transformation and sustainable value creation. So just to give you some highlights, just some numbers. Capacity. The platform grew from 240 to 450 megawatt of capacity today, which is a big increase if you also consider the challenges around energy and supply chain that Gabriele mentioned before. Customer growth and retention. So DataBank reported 11 consecutive years of positive quarters for new contract signs, so new bookings. Compared to our acquisition case, we are more than 160% above expectation. The average contract life is more than 4 times higher, which again gives us, we are an infrastructure investor, so it gives greater stability and visibility of cash flow, which we really like. EBITDA today is around 800 million, or more than 50% up versus acquisition, and 3 times higher versus the initial forecast. And then a mix of organic expansion and targeted M&A, which is really strengthening the portfolio and positioning the company also for the next phase of the growth. So this is for us a responsible growth model. Is not just speculative, but it's really industrial discipline and built for resilience. And this means that DataBank is not only scaling, but is building a platform that can combine financial strength, operational excellence, but also sustainability. And this is how you create long-term value in a market that's defined by complexity and by rapid change. So going back to the initial question, and more importantly, this is not the end of it. And with that, again, I'll hand it over back to Gabriele, who will discuss how DataBank is addressing the current market challenges and also what's next, of what's ahead for the platform.
Thanks, Eddie. And I think DataBank has been thus far a really fantastic success story for us and for our partners. And this, despite the fact that the industry is growing rapidly, but is also facing new challenges regularly. And I think what really sets DataBank apart is how it's proactively managed these risks and concerns, but also anticipated some of them. So I'll avoid repeating what has already been said, and maybe focus a little bit on what we've done at DataBank with respect to some of these key risks and headwinds. So, on the overbuild risk, it was strategically decided that, we would solely focus on demand-driven development in tier one markets. So, avoiding the temptation of going to build a large deployment in the middle of nowhere, as we're seeing now. We're sticking to our strategy. We are market leaders in 6 or 5 metro regions in the US, and we'll continue to lean on that to capture growth at good terms. We've also focused on phase capacity. Phase capacity means not doing one single site at 500 megawatts, but actually building campuses where you can phase your capital deployment, your CapEx, and your investment as you pre-lease the commitments periodically. This ensures high utilization and minimizes volatility. With respect to power availability, we don't speculate. So, DataBank secures powers upfront that guarantee the availability and even goes as far as coding projects to automate power billing, which really turns a constraint into a competitive advantage compared to other offerings. The third point, which is probably the one that we take quite a bit of pride in terms of being able to anticipate trends before they materialize, is how we've managed supply chain constraints. So even before the rise of inflation and interest rates and everything and the AI, call it surge, DataBank had already put in place what we refer to as our stocking program, which is pre-orders and long-term vendor agreements that not only help us keep projects on schedule, but more importantly, ensure and insulate, call it, construction and price volatility during the cycle. Thirdly, technology risk. DataBank future-proofs its facilities, both with flexible cooling and power configurations, already today ready to support next-generation workloads. And finally, capital concentration. So this is really focusing on a few but large counterparties. So as Elisabetta mentioned, DataBank addresses this risk by really diversifying its customer mix across retail, wholesale, hyperscale, and reducing the concentration risk. So these initiatives, combined have really helped us improve ROI predictability, secure growth capacity, and really position DataBank as a resilient operator in a growingly volatile market. And if we turn the page and we try now to have a look at the future, where DataBank is going in the next decade or so, I think the trajectory is clear, but more importantly, the foundation is already in place. So today's capacity it stands at roughly 450 megawatts. By 2031, we expect that number to be closer to 1.2 gigawatts. So it's a 750 megawatt increase, primarily driven by hyperscale and hedge demand. This isn't just expansion, it's really strategic scaling. And we say that it's strategic scaling because of 4 key points. The first one is the ownership model. So 100% of the development that we see in the future is associated with land that we own, which means control, cost stability, and obviously insulation to volatility. It means secured inventory. So we said that we own the land, but also the power is locked in. And our stocking program really ensures that critical components are available, mitigating any supply chain risk. It is capital readiness. So all the equity and financing that we need to execute on this plan is secured beyond 2031. This provides obviously long-term funding certainty, which our counterparties are looking. And finally, the unique positioning. So DataBank's distributed platform, interconnection-rich ecosystem, and really the universal hall design really enables flexibility and scalability for any workloads that we need. So we feel really good about where DataBank is sitting today, and it's really on track to become the premier hedge and diversified platform in North America, delivering scale, connectivity, resilience for all types of workloads. Which brings us to the end of our presentation. I've taken the challenge to try to summarize a little bit what we've discussed over the past 40 minutes or so. I think if there's anything that you should recall from this conversation is that the digital economy is accelerating, and data center are at its backbone. This is just not a passing trend, but really a structural shift driven by AI and connectivity. What this means for investors like ourselves is that the fundamentals are compelling. So strong demand, limited supply, high barriers to entries, and the list goes on. And finally, platforms like DataBank with secure land, power, and interconnection-rich ecosystems are really positioned to deliver scale and resilience. Finally, for us, investing in digital infrastructure today is far more than just generating strong return. It's really about enabling innovation and securing long-term value in a rapidly evolving market. Thank you very much, and we're now open for Q&A.
Perfect. Thank you very much, guys. A really interesting, holistic presentation on data centers, and the information for the audience. We're of course happy to take your questions. I think you already mentioned in detail lots of market challenges and how to adapt to market challenges. And I think for investors, it's most important, of course, to understand the risk of investing in data centers. So one of the risks you mentioned is the potential of a stranded asset. And of course, nobody wants to put a future stranded asset in the portfolio. And of course, there's a risk, especially when you invest in data centers, because of the rapid development of advanced chips, supercomputers, and so on. So the rapid development in the sector obviously pose a risk to data centers. So how do you measure that risk, and how do you make sure that an investor doesn't get a future stranded asset, a future stranded data center in its portfolio?
Yeah, I mean, it's a good question, and there's a short and a long answer. The short answer is that at least on our end, we're not willing or interested in taking single asset, single counterparty type risk. I think those who are looking to do those types of deployments are doing it as part of a broader partnership, where I think the strategy will involve more than one just site. But we've seen at least in the U.S. In the last, I'd say, 3 to 4 months, announcements of campuses in places like North Dakota, Wisconsin, Louisiana, and other states where between us on this call today, there is no other data center market. So they're going there because land is more affordable, but more importantly, power is available. And when you take that call, you need to ensure that the underlying contract that you're signing up to with most likely a Google, a Microsoft, and AWS is long. So anything below 15 years starts to be problematic. 2, the terms and conditions allow you not only to recuperate your capital during that 15-year period, but also make your return. Because I think the world is going to change many times between now and 2045. Therefore, the needs and demands of those hyperscalers might shift and change, and therefore there is a real risk about that asset being rendered either obsolete or equally being really under negotiating pressure or having little leverage to set terms with the hyperscaler upon renewal. So, for us, taking single tenant, single asset in a 1 gigawatt campus, which implies $1 billion of US dollars of equity, is not something that we would do.
Okay, and to add on to this question, so do you think that the types of data center that you refer to, do they matter in this regard? So is it important to take a different look at different types of data centers regarding the potential for a stranded asset?
Yeah, again, I don't want to. I think I think investing in different typology of data centers and with different strategies really depends on what type of risk appetite an investor has. For us, I think diversification of markets, diversification of risk profile of our tenants, diversification of workloads is what has allowed us to not only manage some ups and downs, but also optimize the growth trajectory of DataBank. When we say that the world is moving rapidly, you don't have to go back decades. You have to go back 6 months, maybe 9 months. And if you look it up on the internet, everything people were talking about was new AI applications coming out of China, implications for the large, call it Western hyperscalers, and some large them, Microsoft, Google, and AWS, pulling away from large LOIs for new data center rollout. We at DataBank did not flinch, because if a hyperscaler decides to go and pause for 12 months on where they want to deploy and how they want to build their data centers, our inventory and our strategy allows us to then pivot and sell capacity to NVIDIA, to JP Morgan, to Apple, to Mayo Clinics, and so on and so forth. So we actually ended up having a fantastic, call it Q2 and Q3 in terms of booking with retail and wholesale colocation, while the hyperscalers figured out what they wanted to do, just to finish the year with a massive contract with Oracle that was more of a cloud and AI type of compute in South Dallas. So I think when you have that flexibility, it allows you to manage the moments of pause, which I think we will continue to see in the coming years, as I think the end game for AI is still a big question mark. But we've deliberately decided to keep that flexibility and diversification, which is key for us in terms of executing our strategy.
Great. So you already mentioned that, of course, location matters, and you brought along the great example from the US, but regarding Germany or the EU, so can the infrastructure in the EU keep up with the AI or data center economy? That's the first question. And the second, so what does it take to get a data center finance in the US and in the EU? So the background is that more and more communities are pushing back on the development, like they don't want the data centers in their backyard because of the pressure on power grids, environmental concerns that are raising, and along with environmental concerns, of course, regulatory pressure that may come up, a question on insurance coverage. So what does it take nowadays to get a data center financed and built?
It's an excellent question, and one that I think captures many different aspects. So I think I'll try to answer a few of the questions that you had in there, Philip. The first one is call it social acceptance. Let's put it that way. I think it is a growing trend, not just here in Europe, but also in the US, where I think there is a lot more work that needs to be done in convincing the communities that there is a net benefit beyond just building the data center. Again, if you look up at some of the large announcements that were made in the US these past few months, all of them come with commitments to invest in communities, to gain better acceptance, if you want. No one wants to have a large data center in their backyard. I think we're seeing the first steps of what maybe we've seen in Europe, or at least in some countries in Europe, around wind farms in terms of pushback. But again, I think that is one element. The other element is how power hungry these sites are. Not only in Europe, but again in the US, there is starting to be a bit more concern around whether the escalation of power demand, which will involve massive investments, not only in terms of generation, but also in terms of updating the grid. But generally speaking, it's the end consumer that pays for the grid upgrades in terms of, call it, electricity transmission. So the regulators are now getting drawn into some of these dynamics to improve planning, but also do better cost appropriation of the upgrades that are required. Leaving aside some maybe dynamics that are different across markets in terms of integration of renewable energy to fund and to fuel the power needs of these sites. When we try to look a little bit closer to home, considering that Elisabeth and I are based out of Zurich, the dynamics here in Europe are very different than the ones in the US. They are what we refer to as the flat D. So it's the big hubs: Frankfurt, London, Amsterdam, Paris, and then Dublin, which are starting to be saturated or are saturated. So it creates now the need to sort of expand to what are referred to tier 2 markets. So we're seeing the emergence of markets like Milano, Madrid, and other regions in France around Marseille because of connectivity to subsea cables and so on and so forth. And then we're seeing self-built primarily by the large hyperscalers in the Scandinavian countries because, as Elisabeth mentioned before, power is cheap. Latency is not required right now, so they're going where cooling and powering is more affordable, and when they current the big center. So it's going to be, I think it's going to be a different model to be applied in Europe than what we're seeing in the US, which is by far the largest data center market in the world. And then you had the complexity of land scarcity in Europe, grid constraints, interconnectivity with fiber, and also sovereignty risk, as different countries would like to keep their data within their own boundaries. I think the scale of what we're going to see in Europe is going to be a lot smaller than what we're going to see in China or in the US.
Great, Gabriele, thank you very much for going into detail and answering all the questions. I don't see any more questions from the audience at the moment. So thank you very much again for the Q&A session, for the presentation. Also, Elisabetta, thank you very much for giving us this holistic overview. And for you and the audience, I wish you a pleasant day. Enjoy Christmas and the time being. So thank you very much again.
Thank you.
Thank you, everyone.